Well, it was another day when we saw the benchmark indices largely being under pressure today. We also saw some pain essentially in the broader markets, but let's first start with the Nifty. It fell from 200 points from the day's high, and quite a similar performance that we saw on Tuesday as well before the market holiday yesterday, where we've seen continuous pressure on the Nifty and no recovery in sight. For the Nifty 50, we saw stocks like Shriram Finance as well as HCL Tech fall the most, while some stocks in the auto space like Hero MotoCorp and Eicher tried to provide some solace. They also ended below the day's high as well and saw some massive correction in the Nifty auto as well, with most stocks slipping in the red at the end of the day. Apart from that, Nifty has fallen over 2% in the last 5 days, and that's largely based on what's happened with the tariff tantrum amongst other reasons. The GST did provide a boost to the market as well as some key sectors like auto as well as electronics and consumer durables, but that failed to sustain and ground over essentially over what's happening with the global geopolitical issues. Apart from that, we've seen the Nifty fall nearly 1% for the day. Benchmark indices largely were slightly higher than the broader markets, but even we saw pressure in the mid cap and the small cap as well. In the mid cap 150, it fell over 1%. That was dragged essentially by Poonawalla Fincorp as well as Aditya Birla Corp amongst other stocks. We've also seen essentially over the small cap lose over 1%, led by stocks essentially like Electra Green Tech as well as something like CESC, which also dragged the small cap index down. Finally, in terms of sectoral indices, the Nifty IT essentially fell the most during the trading session today. If any, we could see some solace if there's a rate cut in September, but till then, we could see some pressure on the Nifty IT over the medium term as well. Apart from that, it emerged as the worst sector for the day. HCL Tech as well as LTTS was the other stock that got impacted. ICICI Bank and HDFC contributed the most to decline essentially in the Nifty, and the Nifty Bank as well as Financial lose for the fourth consecutive session. We will be entering a new expiry from tomorrow. Foreign investors have largely maintained short positions, but we are expecting, at least for now, not any kind of meaningful triggers which could have a positive impact on these indexes.
Thanks, Puneet, for that. Meanwhile, the tariff shock has set off a wave of market reactions. And to understand its potential impact, we spoke with Amish Shah of BofA Securities and Anup Dhawan, former Commerce and Trade Secretary. And here's what they had to say. Listen in.
Absolutely, tariffs is one of the factors that can drive sensitivity for markets, both in terms of earnings and valuations. So I would argue that, look, markets are currently trading at around +1 standard deviation, around 21.5 times. 50% tariff, currently nobody expects to continue. Most of the market participants believe that this is a matter of time. We would probably over time revert to 20 to 25% tariffs, and that's what markets are pricing in. But clearly, if 50% stays for longer, then we could have the 11% downside case that we are arguing for right now. So basis the conversations with investors, I think everyone's expecting this issue to get resolved within a month or two. But anything beyond that, I think markets will start to price it in negatively.
Amish, again, just trying to understand, because you look at numbers and timelines so closely, for the markets to start baking in 50%, is there a time limit? Let's say that if indeed no resolution comes in for the next 60 days maybe, or 30 days or 90 days, then you in your models as well start factoring in a 50% tariff impact both on earnings as well as multiples.
Positive directionally. So clearly, I think government is doing the right thing. Their policy, both in terms of fiscal as well as monetary, is to stimulate growth in this environment. We've seen a total of $48 billion of consumption stimulus so far, which is about 120 basis points of GDP. If you think about it, the additional subsidies given out over the last 12 months, mostly by the state government, some from the center, is $24 billion. Over and above that $24 billion, you had $12 billion come in through the tax cuts, direct tax cuts that were announced in the budget of February. And then possibly our expectation is that there will be another $12 billion coming in the way of GST cuts. So $48 billion, it's about 120 basis points of GDP. Over and above that, there will be some savings in the form of lower EMIs, from the lower rates that we spoke about, plus there'll be more liquidity into the system. So there is about, all put together, about 150 to 170 basis points of stimulus, depending on which way you calculate it. And that's the right thing to do. There is a need to stimulate growth right now. Government is going all out and stimulating that growth. Coming back to markets and implications, however, we think that the markets have more than priced in that recovery, and we think that the recovery is likely to be shallow in comparison to the street expectations, and therefore arguably earnings cuts will continue.
Meanwhile, government sources have said on US tariffs, and this is the latest that's coming in, what we're hearing right now, is that the new 50% tariffs imposed by the United States are set to significantly dent India's trade flows. Officials admit, however, that could be only a short-term disruption as supply chains are forced to recalibrate, but stress that resilience measures are already in the works. My colleague Rishabh Bhatnagar, who has been tracking the story very closely, now joining me on the phone line with more. Rishabh, take us through what exactly government sources are saying and how they're reading the situation henceforth.
Right. The commentary that is coming in from government quarters is the fact that there is some sort of an impact expected of these 50% tariffs that came into force yesterday. Lots of sectors like gems and jewelry, chemicals, home decors, which includes carpets, furniture, all of them are expected to be suffering a little bit of losses. That is, the government is very cognizant of that fact. They've also mentioned that a new date for negotiations for the U.S. bilateral trade agreement have not been fixed yet, but channels are open, and the next formal in-person round could be could happen very soon. Now, given the fact that the government is cognizant of the pain that these exporters might be bearing over the next 5 to 6 months, there is talk of addressing all liquidity-related asks via this export promotion mission. Now, this is the same mission that was proposed in the budget, but the outlay then was about 2,250 crore rupees for a year. Now, what it is being envisaged as is a 6-year package with 25,000 crores worth of incentives. And these incentives will, of course, include old schemes like RODTEP that might be restored. You'll have interest subvention schemes. You'll have market access initiatives, all built into it via 2 sub-schemes called Niryat Disha and Niryat Protsahan. That's what we're picking up. We're also seeing that the government is keen on expanding e-commerce exports. And that is a story we broke a couple of days back with the easing of FDI norms that might be coming in. What we're also picking up from the government is the fact that there is domestic demand that is being tried to be upended. What we're seeing is that you have the GST rate rationalization, you have a big reforms agenda that the government is pushing for, and all of that is domestic demand, which will also cushion some impact of these tariffs coming in. So you're seeing fast-paced consultations for these export promotion missions. So all ends the government is working towards easing the pain of exporters will be facing a majority of the brunt of these tariffs.
Right, Rishabh, thanks so much for that update. This is the latest that's coming in. What we're hearing from government sources is that they are expecting the 50% tariffs to be a jolt, but a short one nonetheless. Let's move on now, because in a diplomatic move amid escalating US-China trade tensions, Chinese President Xi Jinping allegedly sent a letter to Indian President Draupadi Murmu back in March, signaling a desire to improve ties with India. The letter, later conveyed to Prime Minister Narendra Modi, expressed concern about US deals that could harm China's interests. It also named a provincial official to lead diplomatic talks with India, and this outreach is what helped revive India-China engagement, paving the way for renewed discussions. Remember, a very crucial meeting taking place this weekend on border disputes and economic cooperation. My colleague Puneet now standing by in the newsroom, joining us with more on this. Puneet, take us through this letter, this secret letter, like it's being termed, that was sent back in March, and how it actually paved the way for India and China to mend relations, and more importantly, what this actually signals economically and geopolitically.
Well, definitely, it is one of the key aspects that is coming out from the story because we have seen improvements of ties as well as negotiations between India and China, and now with this letter coming in, it does link to what led to these ties being improved in the first place. So, Chinese President Xi Jinping has actually written to President Murmu and on essentially on improving ties as a key topic, and the letter has expressed concern about your US deals which could be impacting China's interest in the global medium term. They've also said essentially that he's named a provincial officer who would steer these talks with India at this particular time frame. The letter goes on to say that it was sent to PM Narendra Modi in June, and essentially onwards we've seen those talks take place, as well as improving relations with India and China was one of the key topics of the said letter. Now, from India's side, the NSA Ajit Doval is leading the talks, is what this letter has gone to say. Apart from that, we've also seen the China has assured India of some key supplies of fertilizers as well as rare earth magnets, which is having a key issue right now in the automobile sector across the world. And with these assurances, India has also gone on from their side and initiated conversations of starting direct flights with China, amongst the other key measures which has happened. So from September onwards, the direct flights between India and China will start, and India has also lifted curbs on tourist visas for Chinese nationals as well. So this could lead to a multi-level delegation as it is happening right now, and could have some positive measures between the two countries. But the letter now puts on the key facts of why these conversations have started to happen and pave way as well, and gives us some key insights from President Xi's style of working with the government.
Right, Puneet, thank you so much for that update. This is Xi's secret letter being sent back in March. Remember, a very crucial meeting going to be taking place on Sunday. We'll be bringing you live coverage of the Prime Minister's meeting as he visits Japan and then later China. Moving on, India is projected to become the world's second largest economy by 2038 in purchasing power parity terms, with a GDP forecast of $34.2 trillion. This is according to the 2025 issue of the EY Economy Report. NDTV's Sakshi Bajaj joins us now with more details.
Big boost for India's economy at a critical time, really, with, of course, this projection coming in that India may be the world's second largest economy by 2038. This as per our EY Economy Watch report. Remember, this is the research team that has given this report. Now, the report is really saying that, look, India could be the world's second largest economy in purchasing power parity terms. For our viewers to understand, when we say that, this projection for 2038 is in purchasing power parity terms, which essentially means a measure of standard of living across countries, across currencies. So for our viewers to understand what really is $1 equivalent to and what really is the purchasing power of 1 rupee in comparison, that really is essentially what the report is measured upon. Now, the report is also saying that, look, India can, with effective countermeasures, handle the higher US tariff impact very, very well. They're saying that, look, among the world's 5 largest economies, India's economy at the moment is the most dynamic. So these really are the broad highlights coming in from the report. But what are really economists making of this report? While they're saying it's a big boost at a time when India is hit with the 50% tariff rate from the US, it is a critical time for this report to be released and an optimistic outlook at that. However, they're saying that, look, we have to keep in mind that this report is long-term in nature. The projections are for 2038, remember, and they're saying that, look, the reforms really must be implemented. So the trajectory really and the spotlight really is on the implementation of reforms, and really how swiftly can India implement the reforms that are really, it's the need of the hour, economists believe, to unleash reforms, and multiple ones at that.
Meanwhile, the 50% US tariffs on Indian goods has come into effect, and over the coming months, the gems and jewelry industry could face significant cascading impacts, risking its global shine. My colleague Harsha from NDTV was at the Jaipur Gems and Jewelry Hub and brings us an on-the-ground report highlighting the challenges that the sector now faces. Let's take a look.
Gems and jewelry is the highest revenue earner for Rajasthan in terms of foreign exchange, much more than tourism. In fact, 18,000 crores are the estimates that the gems and jewelry business earns in Jaipur. And of that, about 3,200 crores is the US market, which is about 20% of the total export. I have with me Alok ji, who is the president of the Jaipur Jewelers Association. Alok ji, क्या लगता है आपको, what is going to be the fallout? अगर इस तरह से, if the tariffs have already come in, they've already kicked in, so now how is it going to impact the business? I mean, it's the biggest foreign exchange earner for Rajasthan.
It's a major disruption that we are going to see now. And the effect is, as we see today, if things are not sorted out in the near future, there'll be a lot of pain. And that includes the businessmen, small, medium, large, doesn't matter, even, and the artisans. Once this cascading effect goes down and people start leaving this industry, then it will be very difficult to just gather them back together.
Alok ji, आपका जो business है, how much of it is driven by America actually? कितना percentage? और किस type का जाता है? आपने बताया कि finished jewelry भी जाती है, and there's some loose gemstones.
Yes. So we are majorly into jewelry exports, studded jewelry exports, and about thankfully we are not so much into American market, but still about 10 to 15% of our exports are to America. So that is what we are seeing. It's the season is coming, but what we are seeing is this will be zero this year.
Also, this segment employs at least 2 to 3 lakh labor in Jaipur alone, and they're going to be severely impacted. In fact, a lot of the labor who work here are from outside Rajasthan. आपका नाम क्या है? हाँ,
सेतवान।
हाँ, कहाँ से हैं आप?
यूपी।
हाँ, तो जो जैसे ये बात हो रही है कि भाई अमेरिका ऑर्डर देना कम कर देगा, तो फिर डायरेक्टली प्रोडक्शन हाउस में ऑर्डर कम होएगा, तो फिर तो कारीगर पे तो इम्पैक्ट आएगा ही ना?
आएगा।
हाँ हाँ, क्या चिंता है?
चिंता है घर परिवार अपना हम कैसे चलाएंगे, इसी से कमाते हैं तो अपना खर्चा चलता है.
I have with me Sudhir Kasliwal. The Gem Palace is one of the oldest shops in Jaipur. But Sudhir ji, with the kind of tariffs that we are seeing, the new administration, Trump administration, you also had made inroads into the export market. You were also sending jewelry abroad. You were not just doing traditional jewelry. How badly has that been hit?
You see, almost 60 to 70% of our export orders have been kept on hold lately after the Trump tariff announcement.
What are your customers saying about that? I mean, they must be with you on email. What is the concern?
The concern is increase in cost because they are wholesalers and they are also going to sell it to their customers and they must have quoted a price. We have also quoted a price. So the price hike definitely will affect their sales also, and our sales are being affected for sure.
So 60 to 70% of export orders is a huge hit for any business to take. Also, you know, Jaipur is also a thriving tourist industry. And a lot of tourists who come here also come shopping. They come to buy gems and jewelry. In fact, it's always on the shopping list of every tourist who comes in, especially the upmarket tourist. So will they also be affected? Do you think domestic sales to tourists, foreign tourists will also be affected?
See, our sales are mainly to foreign tourists. And out of all the domestic, the foreign travelers coming to Jaipur, our sales are almost 70 to 80% to American tourists. They are our big buyers. Now, that is also going to be affected because that we'll see in the coming season, because now it's not a tourist season, but it's definitely going to affect our business.
So that's how the cascading effect of the Trump tariffs will slowly be visible in the Indian market. But for now, the Trump tariffs have sent tremors down Jaipur's jewelry business, and it's threatening to take the sheen out of what was once a glittering business for both import and export.
Right, and let's move on to a quick update coming in. Government sources are saying that the group of ministers has now proposed an early phase out of the GST compensation cess, recommending that it be replaced by a separate levy or subsumed under GST rates altogether. My colleague Shrimi Chaudhary now joining me on the phone line with more details on this. Shrimi, we understand that the GOM is aiming to end the compensation cess by as early as October 31st. Give us all the details.
Yeah, so as you mentioned, this GOM led by Pankaj Chaudhary, MOS Finance, has recommended in its report an early phase out by October 31st of this compensation cess ahead of the original deadline of March 31st, 2026. Now, the final decision, of course, rests with the GST Council in its upcoming meetings scheduled for September 3rd and September 4th. What they have recommended at this point in the report, which they submitted to Council, is two key options on the compensation of, the future of compensation cess. Is one that either replace the cess with a separate levy or additional levy, or integrate it with the broader GST rate framework. So the council now will deliberate on these options during the meeting, and in fact certain numbers have been also quoted by the GOM in its final report, saying that the collection from the compensation cess have already reached to slightly over 50,000 crore up to July 2025, and based on the current trends, by the time they reach October end, it will be around 88,000 crore. So what the suggestion is that there could be some surplus, of course, over and above the back-to-back loans which government has taken and which led and triggered the extension of the compensation cess, and that will be distributed among center and state equally. So, of course, the council will, decide a further, strategy how to go about it. But for now, they are suggesting two options, and of course, the early phase out of the cess regime.
Right, Shrimi, thanks so much for that update. This is what the GOM actually is proposing, and we'll get into more details as we get in the developments. Thanks for that, Shrimi. Moving on now, we have learned that India's industrial output in the month of July grew by a solid 3.5%, coming in at a 4-month high. This indicates a steady industrial performance despite Trump's tariff pressure. Now, I'm going to bring in Pallavi for a quick detailed breakdown of these figures. Pallavi, over to you.
Right. So, as you've mentioned, IIP growth has come in at the highest in 4 months at 3.5% for the month of July, and this is compared to a print of 1.5% we had seen in June, and this was largely on the back of manufacturing, which actually comprises the largest component of the index. So, manufacturing grew by 5.4%. That's on an annual basis, and that's compared to about 3.7% we had seen in the previous month. Meanwhile, the other components of the index, that's mining and electricity, actually saw a contraction, with mining falling 7.2%, largely might have been because of the ongoing southwest monsoon season, while electricity production fell 0.6%. Now, let's also take a look at some of the quick key IIP internals. Primary goods output contracted 1.7%, whereas capital goods grew by 5% and intermediate goods grew by 5.8%. Infrastructure, consumer durables also saw a growth, 7.2% and 2.9% respectively, whereas consumer non-durables saw a contraction. All said, this print was above what was being estimated, and given that we have seen tepid prints the last few months, it is an encouraging one at that.
Right. Pallavi, thank you so much for that update, these industrial output figures coming in. That's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. You know, a negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Hello and welcome to KYC, that is Know Your Company on NDTV Profit. My name is Hiral Datia and with me is Puneet Javeri. Today on KYC, we are going to actually dissect a Quest Corp in trade. It's going to be an interesting company to talk about, and the scenario is absolutely interesting as well. The reason being is what's happening with hirings right now, because all of us have been talking about the negative impact in terms of where IT as a sector goes, because that's where majority of the downtake that has happened so far. But let's quickly run you through as to why a Quest Corp. Firstly, we want to understand the business outlook for FY26, and the reason why this is important is after the three-way demerger that has happened, how is business actually shaping up? Moving on, if you talk about the other aspects, which segments will lead the hiring in the second and the third quarter, which usually is an absolutely strong quarter? That's the second question that we ask. On number 3, what's the outlook looking like for GCC hiring, as IT as a sector has been slowing down as well? And moving on, can the professional staffing sustain the double-digit margins that we've seen so far? So these are a few of the questions that are on my list. Puneet, what are you going to look at as well?
I think one of the key aspects is, of course, of the company is largely into hiring for both banking as well as for technology, and that space has been largely impacted from the tech space. So I think that will be one. Monsoons, amongst other reasons, has been one of the key aspects which is impacting a lot of companies, but those are some of the key aspects to look at.
Right. In fact, will Middle East and Singapore growth also continue from here on is what we need to watch. What's the plan for on-site as well as GCC business transfer is what we should be looking at. And very lastly, how is the Hamara Jobs ONDC integration progressing for the company? So we usually look at 5 questions. These are 8 questions that we will try looking at with the management from here on. But moving on, let me quickly take you through, about Quess Corp. Firstly, as we know, the company is in the business of overall staffing is what we know. Apart from that, if you look at the presence, 9 countries is what they're present in, and they have a workforce of little over 550,000 associates, serving over 3,000 clients across diverse sectors. Talking about the demerger as well, they have done a 3-way demerger. All the 3 companies have been separately listed now. The main business, which is Quess Corp, is into workforce management. And the first new company is Digitide, which is into BPM solutions, InsurTech, as well as the HRO business. If you talk about the second one, which is Blue Spring, that company is into facility management, industrial services, as well as investments. Overall, if you talk about the market split as well, Quess Corp, it actually had a market cap of around 3,900 odd crores, Digitide around 2,900 odd crores, and Blue Spring around 1,200 odd crores. And this is basis the split that had happened then. So let's just be very mindful of that aspect. If you talk about the first quarter as well, in terms of the matrix, Quess Corp around revenue of around 3,650 odd crores on a PAT of 50 crores. Blue Spring reported a loss and a revenue of around 800 odd crores, and Digitide a profit of around 10 odd crores on a revenue of around 740 odd crores. General staffing, professional staffing, overseas business, and digital platforms. These are the segmentals that you're looking at, where general and professional has seen an uptick, whereas overseas business and the digital platform has seen a degrowth from 5 to 18%. So that's with regards to everything that you need to know about the company. But let's quickly take you through the rating parameters from here on. On the first one, we have the income statement that we are talking about as well. We'll talk about the balance sheet, cash flow, return ratios. Moving on, if you have to look at the other 4 parameters, the shareholding, street credentials, street coverage, and valuations. This is what we will discuss from here on. Puneet, let's start with the income statement.
Well, definitely, it is one of the key aspects, because we've seen the demerger happening now of this particular entity. So you are seeing some kind of revenue correction that we've seen. Now for FY25, and we've only taken the last 2 years because these are comparable post the demerger. If you see from the FY23 level, compare the FY25 revenue, you will see a dip, and that's largely because the 2 demergers of the 2 new companies that Hero just spoke about. So in that aspects, 14,990 crores is what they did in FY25. It is a growth, but you will see that there's an impact on the net profit substantially. It's down almost 6 times from the FY24 level. This was largely because of a demerger expense of about 30 to 40 odd crores that they did, as well as a write-off of about 118 odd crores, which impacted the profitability in FY25. So that has dragged down essentially the ratio in this particular aspect, and for that reason, we've given this a thumbs down. And in FY26, they are expecting some of these expenses won't be a part, especially the demerger expenses. The receivable aspect will be something that we'll quiz the management on. But on this aspect, we've given this a thumbs down.
Right, so that's with the income statement. Let's quickly look at the second parameter, which is the balance sheet of the company. Now, what's interesting in terms of the balance sheet is their net worth to an extent has come down significantly from a 2,800 crores that we saw in FY24. It's actually come down to little over 1,000 odd crores. And in terms of the cash and bank as well, that is nearly halved for the company. So these are 2 aspects that we are looking at, because of which we are giving it an absolute neutral rating so far.
Specifically, this has also seen that kind of demerger impact, which we've seen move.
There will be some movement that will happen, correct, to the other companies, which is Blue Spring and Digitide.
Yeah. And in terms of cash flow, let's move on to the third metric now, and that largely seems to be stable-ish to say the least, because we've seen that kind of degrowth in terms of hiring trends. You're seeing that impact in FY25 as well. Companies guiding for a better performance in FY26 that will be led by professional staffing as well as the hiring in GCC trends. So we've given this a neutral, not given this an absolute thumbs down, largely basis of this aspect of a better outlook. But for FY25, it was still a better performance compared to FY23, but a neutral rating, giving the uncertainty in hiring for the tech as well as among the other sectors that it caters to.
Okay, so that's with regards to where cash flows go, but let's look at the return ratios. Now, what's interesting with the return ratios is if you have to look at 23, 24 and 25, it's the lowest. So clearly, the return ratios are well below your historic highs that you've seen as well. In fact, 10.36 is where the return on capital employed was in 2024, 23, 8.45, and right now 2.92 is really low. Simultaneously, if you talk about the return on equity as well, there again that number is in single digits, 2.36 lower level versus a 10.35 and a 8.97 that we've seen in the previous years. So clearly there is improvement that is needed on the return ratios, and that's the reason why we give it a thumbs down so far.
And essentially, the return ratios are expected to go and do better going forward, largely led by, what is happening in GCC trends amongst others, because that is a very, very high margin business for the company. But clearly the trends, seeing that impact of the high margin businesses moving to the other key verticals, and hence thumbs down. The next one is shareholding, and this largely, we've given this, in terms of shareholding, largely, in this particular aspect, a thumbs up, and that's because of maintenance of that kind of shareholding that this one has kept. So from 56%, it's largely been there. We've seen some increase from March of 2024 in terms of the level for public shareholders, and hence, we've seen in terms of the stock largely underperforming, the retail investors coming in anticipation of a better growth area. But we've given this a thumbs up based on the confidence that the promoter has kept in the business.
Okay, so that's with regards to where the overall return ratio shareholding goes. Street credentials is that we've already spoken about as well. Valuations, let's quickly look at that aspect from here on. If we can just get the overall street creds on the screen. In the last 6 months, we've seen a downtick of around 55 to 56% in terms of where the stock price goes. That the counter has actually underperformed in all parameters. If you have to look at the last 5 years as well, it's a downtick of around 31-32%. So not really rewarded the shareholders to that extent. So that is what we need to look at from here on. But, as Puneet was mentioning, the GCC hiring, which is a high margin business from here on, if that is able to improve the business, in turn, improve the return ratios as well, potential for things to come up and reverse. And that's a question that we will check with the management. But overall, a thumbs down in terms of the street credentials, Puneet.
Well, and that's largely also seeing that kind of merger impact which we saw in April. About pre-merger, the price was 604. Post-merger, we saw that dip to 400. But since then as well, we've seen some form of impact on Quess Corp, largely basis on the operating performance as well. In terms of valuations, the nearest competitor is TeamLease, and we've always seen that kind of valuation differential between both these firms. Currently, valuation for both seems to be, on the lower side for FY27 specifically, baking in the negatives for this year. The outlook, of course, will be something to watch out for as we go into Q2 and Q3. Q2 and Q3 are, big seasons for hiring, and that does benefit companies like Quess Corp as well as TeamLease. But at least for both, on both the next couple of years, we've seen valuations largely been positive compared to TeamLease. But in terms of growth, that largely has been absent, and hence we're giving this a neutral for now. But in terms of commentary, that depends on what happens in Q2 and Q3, has some upside risk to say the least, and that's reflected essentially in the analyst ratings as well.
Valuations absolutely reflective in analyst ratings, but let's quickly just go through everything in terms of the street credentials that we're looking at in terms of coverage. 8 buy calls, 1 hold. But with that as well, you have a 42% upside, right? So from what Puneet is mentioning about from a valuation perspective, the business perspective, the GCC that could start contributing, probably that is what is being indicated in the upside that, the analysts are giving right now. And 8 is not a bad number, and hence a thumbs up in terms of where the street credentials go, the coverage goes. Let's quickly look at the final performance now. So the income statement is a thumbs down and your return ratios are a thumbs down. If improvement comes in, probably that could change in the future. Balance sheet cash flow, absolutely neutral because of the impact of the demerger that we've seen. Your shareholding, street coverage, both are a thumbs up. Valuation right now is sideways, but your credentials, because of the returns that it has given to investors, is a thumbs down right now. So from 8, the overall rating is a 3.5 in terms of where Quess Corp goes right now. the conversation that we will have with the management is actually going to tell us how this 3.5 probably will improve from here on or not. Let me welcome in Guru Prasad Srinivasan, Executive Director and CEO at Quess Corp. Srinivasan, welcome to the show and a pleasure to speak to you at NDTV Profit as always. My first question coming to you is, overall, you know, with the demerger that has been done, now the business that Quess Corp will actually focus on, what's the outlook looking for FY26? Because usually Q2, Q3 is a strong quarter for the company. So taking aspects into consideration with what's happening around IT, the GCC business that you're looking at as well, which is a high margin business, how is Quess Corp actually stacking up?
Sure. Thank you so much and happy to join you all on this call. So first and foremost, let me start from the demerger structure in itself. So we had a very successful demerger, which officially we announced, and two other companies that got listed in the month of June. So Q4 results itself, if you look at, we started, announcing the result independently by each of these entities. So Q1 is the first, standalone result that we announced of independent entity Quess Corp. A couple of specific call-outs. First and foremost, we had a double-digit EBITDA growth year on year, and our debt levels have become, for Quess Corp, debt-level company now. And the other parameters are like post-demerger, the business structure in itself has become far simpler. So we have 4 line of businesses. The first one is general staffing, which contributes about 53% of our EBITDA comes from general staffing business. The second set of business is India professional staffing, where 29% of our EBITDA comes from India professional staffing business. The third quadrant is our international business. About 18% comes from our international, 18% EBITDA comes from our international business. And the last one is a digital platform, which we have incubated for future in terms of building our digital strategies around. So 4 line of businesses, simplification of corporate structure, and debt-free and much leaner balance sheet is what we were able to achieve by Q1, and we've just announced that as a result.
Mr. Srinivasan, good morning, sir, and thanks so much for joining in. It's Puneet this side. You mentioned that debt has now, wiped off from the balance sheet. Essentially, that will help the return ratios for you going forward. In terms of, hiring trends, if you can give us some perspective. Quarter 2, quarter 3 generally is very strong for you. We're almost, halfway through quarter 2, and while you can't talk about numbers, have you seen any kind of hiring revival essentially in sectors like technology amongst others? If you can give us some perspective.
So let me go by platform and business. So Q2 has been definitely, we see a lot of green shoots coming across Q2. If I were to start specifically from a segment, if you look at, I think, general staffing, we have an open mandate of almost about 40,000 plus. To be precise, about 42,000 open mandate that we are on. It's a good way to start Q2. And between July and August, we have done substantial hiring, specifically in manufacturing, consumer retail, and telecom. As you rightly said, India being the season between July to up until Diwali till October, we are seeing mandates, open mandates being fulfilled, and the other sector is supply chain logistics. Specifically, I think, one or two sectors which are a little slow than anticipated is BFSI is slightly slow, but otherwise manufacturing, consumer retail, telecom, and supply chain logistics is doing well. Coming to professional staffing, GCC has been the most spoken about, and we are definitely, while the mandate quantum may not be high, our fulfillment ratios are far better, and we have been able to do good. Almost 70% of our fulfillment comes from specifically from GCC as a segment. So a couple of indicators probably that viewers would be interested. The rural consumption is far higher than urban consumption. 75% rural consumption is coming up from, and that leads to a lot of expense and the investments that can go into the segment, which is helping us to probably do our more open open mandates are coming in from tier 2 and tier 3 segments, which is good to see, than the key markets and urban markets. So almost 37% of our hiring we have done in tier 2 and tier 3 cities as we speak. And most of the manufacturing units are also being set up in tier 2 and tier 3 locations. So that's where we are now seeing a lot of demand coming in, which is in a way good for country like us. There'll be more spending pattern in rural markets. So that is going to give rise to more jobs as we move forward.
Okay. So when you talk about, an uptick that's coming in from tier 2 and tier 3 as well, which segments are you looking at in terms of hiring? What percentage of your revenues will come in from there? And in turn, the margin impact that you see, is it a low margin game or is it a high margin game?
See, staffing would always would be in a range between 1.4 to 1.5% in terms of EBITDA, because it's a volume game. And the way we reorient ourselves is we definitely, headcount is important for us, but profitability is much more important than our revenue. So we focus on our profitability for this business, specifically for general staffing, and of course, professional staffing has always been on EBITDA measurement. So coming back to your question, one third, almost, I said 37% of our hiring is coming in from tier 2, tier 3 segments. Again, the segments which are driving this are manufacturing, consumer retail and telecom, and logistic and supply chain. More e-commerce going closer to the customer in tier 2, tier 3 location, and you need entire delivery and solutioning around it to cater to their customer needs. So plus the retail being the season, and more retail going closer in tier 2, tier 3 location rollout. That is what, these are three segments which are driving, and it also reflects in a similar ratio in our revenue as well as we move forward.
Mr. Srinivasan, my question then is, you're talking about that margin range of 1.3 to 1.5% when it comes to staffing. But now that you're focusing on GCC, you're expanding into, global technology services, which is a high margin business. Do you see that further upside that could come in? And if yes, what should that range look like then?
Good question. So if you look at our results between Q4 and Q1, our contribution from general staffing in Q4 was about 59%. The EBITDA contribution, what I mean. And in Q1, that 59% has come down to about 53%. So while headcount grew and we had net additions, our contribution to overall EBITDA as across Quest for general staffing came down from 59 to 53. So on the same way, if you take the second quadrant, which is our professional staffing, from 21%, we moved to 29%, which means our high margin businesses are contributing well back, which is helping us to, our overall blended margin across group, we moved from 1.8 to about 1.9. And by end of this year, we've been, guiding and we are modeling accordingly to be around 2%, and we are on course to that.
Mr. Srinivasan, a couple of questions. Now, on professional services, you mentioned professional staffing, you mentioned that, the contribution of EBITDA has gone down to 53%, but that continues to be, where the growth essentially seems to be visible. Could you talk to us about what is your strategy for increasing your GCC contribution? Because I think you mentioned that you're roughly around target. You already have 157 GCC companies that you work with, but the scope in India with the increasing focus seems to be much higher. So could you just talk to us about the opportunity, and if you can give us some kind of quantification that we could see in the next year or next couple of years for you specifically from within this segment?
I think just one correction. You said 53%. What I referred to was general staffing contribution coming down from 59 to 15. So that is what I mentioned. And by our high margin businesses going up from 21 to 29%. So that's what I was trying to clarify. And coming back to GCCs continues to be, we have, there are about, if you look at, there are about 1,600 GCCs expected to grow at at 13% year-on-year. By 2030, it is expected to be about 2,500 GCCs who are going to set up their captives back in the country. Of which currently from 1,600 we cater to about 10% of GCCs in terms of hiring. Almost about 3,000 plus around 3,300 headcount of ours are currently present in GCC. So with this, we continue to grow. Probably, I think over 20%. I wouldn't hesitate to say that the kind of demand that is coming in and the fulfillment which is coming in. And as a company, we also pivoted to cater to in terms of building better recruiter capability, bringing in more AI and digital as part of our mix to ensure that fulfillment and delivery happens much quicker and faster. So definitely this particular segment, which is high margin, would continue to grow about 20% year on year for us, and we are slated towards that.
Okay. And when you talk about IT as a segment as well, that's seeing some bit of softness right now. And plus you've seen a decline in terms of the open job mandates as well, right? So how are you actually strategizing to navigate this aspect? Because that is something which has been reflected in the fourth quarter numbers as well.
So this is specific has been the trend for IT services companies. For all IT services companies, absolutely, I would we are not seeing any major demand coming in for Q3 as well this year, as we're already close to Q3. This has been the phenomenon for almost last 6 to 8 quarters, and we only seen headcount coming down there. However, our exposure to IT services is about 15 to 16%. We do hire in a very small format even now, but the exposure or the kind of the percentage what we cater to is about 15 to 16% currently. But otherwise, majority of our demand still comes from out of IT services. See, the other two quadrants beyond IT services are GCC, and another segment within this is all the non-tech companies hiring tech talent for domestic consumption. So there we are seeing a lot of traction. Like companies are into their own automation journey, and there we are seeing demand coming in for non-tech companies hiring a lot of tech talent. Like, look at Quest itself. We'll have about 200 tech talent for our own technology and strategy. People are working for us, which probably 3 years ago wouldn't have been the kind of people. The kind of population that we will have only for technology. So the local adoption is also going up. So from that standpoint, the demand we still continue, or we will continue to see, coming in from specifically from non-tech companies hiring tech talent, and GCCs will continue to contribute more this year.
Right. So, Mr. Srinivasan, everything said and done, understanding what the business is doing, where it is going, what the investors now want to know is when do they start seeing good returns, right? I'm sure you cannot really respond in terms of the way stock is moving, but let's understand from a return ratio perspective as well. We've seen levels of 10.3, 10.4 on both ROE and ROCE. How long will it take you to get there, number one? And two, what's the immediate target that the company has in terms of improvement from levels of 2.9 right now?
So when would the indicators look better? Definitely this year itself. I wouldn't hesitate to say that for multiple reasons. One is we are a debt-free company, and in terms of our equity level post demerger is almost about. If I look at the kind of trajectory that we are in, between 4 quarters, we would roughly. We'll roughly deliver about 350 crores of EBITDA, and our conversion from EBITDA to PAT is higher because there is no much of depreciation line item. So from that standpoint, we are very well slated to be close to a 20% ROE company, which we have been aspirational for some time. But this year, I definitely foresee that indicator is going to be definitely ticked for as a group for us. And of course, the market
higher single digits.
Oh yeah, absolutely. We'll be close to higher teens.
Okay, you're saying in the ROE, ROCE, you'll be in higher teens.
Absolutely.
All right. This is something which I think the street was watching out for. But thank you. Completely running out of time, Mr. Srinivasan, for joining us on the show. So that was the management of Quest Corp, talking to us in terms of what's expected. And I think, Puneet, the last answer is something which actually would make the investors' day from a 2.9 to a higher teens number is really strong.
Well, definitely. And I think those key aspects which we gave a thumbs down on, those did get addressed in this conversation.
So I think that's something we should be revisiting soon, but completely out of time. With that, it's a wrap on this edition of Know Your Company. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. A very old statement is that when two elephants fight, the grass suffers. And this is playing out in the healthcare space. You have an association of healthcare providers which has decided to stop accepting Bajaj Allianz policies for cashless services. Now, if you are new to the healthcare space and if you're unaware of how health insurance works, this will not make a lot of sense to you, but a lot of people will know that a cashless facility is where you go to a hospital and you don't have to pay out of pocket. Because you have a health insurance policy, they will treat you in the event of a hospitalization based on what you have on your policy, based on the cover that you have. Now, if you are a Bajaj Allianz holder or policy holder, you don't have this available in a number of hospitals. And this is over 15,000 hospitals in India. We'll talk about what you should do if you are a customer. And we'll also use this opportunity to talk about health insurance in general. And joining me is Vishal Dhawan, the founder and chief executive officer of Plan Ahead Wealth Advisors. Vishal, thanks so much for taking the time. Let's talk about the issue first, right? We did speak with the AHPI representative, and they have certain contentions. And of course, the company is hopeful of a resolution. I believe that there is some conversation. But it's unfortunate because the customers at the end of the day suffer.
Yeah, I think it is a challenge, because what tends to happen is when you do end up having a hospitalization that takes place, you do want to spend your time focusing on helping with the treatment and the recovery. And very often, making decisions around what's the right course of treatment itself can be very stressful, because there could be alternative approaches that are suggested by doctors. And you need to go through finding the right doctor, finding the right treatment, getting the ecosystem prepared for all of that. And then on top of that, you have to deal with money matters. Now, what tended to happen with a cashless facility, obviously, is that it tended to allow you to focus on all the other items and do away with focusing on the financial aspect of it, at least to a certain extent. And obviously, because the bill settlement was happening directly between the insurance company and the hospital, some of the more technical questions that could arise when a customer was interfacing could get solved easily, because insurance companies and hospitals could speak the same language. So I think when it does go away, it certainly creates a lot of additional stress beyond the normal stress that would anyway arise in these kind of situations.
It's important to talk about all of the aspects that you've just described in a little bit more detail. And it's a great opportunity, despite the fact that we're speaking about this unfortunate situation, to help people understand why cashless is important, why health insurance itself is important. So, Vishal, in your experience, when you go out, in the case of a hospitalization, without a cashless service, what is the kind of situation that you find yourself in? Because you have to have money, first of all, available with you, because a hospital, though they're not supposed to ask for this, will ask for a deposit. If it's not a state-owned hospital, if you go to a private hospital, they can deny you treatment if you don't have the money available to you. Is that right?
Yeah, so typically hospitals will ask for a deposit, to be made available immediately. And obviously what ends up happening is that you have to have access to that money. And this becomes even more critical when you have unplanned hospitalization events. When you have planned hospitalization events, let's say there's a surgery for which you have, gone into talking to a doctor, the doctor said, I plan to do a surgery next week, etc., etc. It's a very different process as compared to when you get into an emergency situation. Maybe it's the middle of the night and, there's been an accident in the family, or there's been a heart situation that seems to have arisen. So I think the approaches can be very different if you're planned versus unplanned. But nevertheless, whether you're planned or unplanned, you need to have money available. And therefore, the important thing that cashless procedures actually ended up doing is very often they allowed you to deal with the planned ones extremely well, and the unplanned ones also reasonably to a better extent, because of the fact that there was already a tie-up between the hospital and the insurance company. I think where a lot of stress gets created by the event itself, I think the financial aspect sometimes can just move that stress to a very different level. And you then need to have money lying around. Very often, you need a credit card, for example, to be able to access to make your original initial payment, or maybe you have liquidity lying in your bank account, so that you can do a UPI transfer. Maybe you have, actually cash available with you, which you can use for that payment. So I think there's a lot of processes involved, but clearly at the start, you need to be putting out some amount of money so that the treatment can happen in the manner that it's supposed to happen.
Yeah, important point. And so therefore, to draw the conclusion from what you've just described, it gets very complicated when you don't have cashless. That should be the first priority, to utilize cashless, utilize a health insurance policy, because it opens a lot of doors for you right up front in the case of an emergency. Of course, in the case of a planned treatment, as you've pointed out, you have more time to plan. But when you're talking about cashless and when you're talking about selecting a health insurance provider, should you be aware of the network of hospitals? Should you be aware of which hospital you would go to in the event of an emergency?
Absolutely. I think there are, some things that are well done or better done when they're planned well. And, you need to plan for emergencies also, as much as it makes it sound strange, because, you would say an emergency is an emergency. So how do you plan for it? But you can do certain things. For example, very often when you have emergency health situations, time is of great essence. And therefore, you need to know what are those hospitals that are in your vicinity, which would become your ports of first call, because you want the treatment to start as quickly as possible. And in certain kinds of treatment, as you'd be aware, there are things like golden hours, etc., in which you need to get to the hospital and start the treatment. What you also want to do at the same time is know that there could be preferred doctors that you have for treatment. And those doctors may be affiliated with certain hospitals and not be affiliated with other hospitals. And therefore, sometimes your choice of which hospital to go to would also be driven by the choice of doctor or medical professional that you want to deal with. And obviously, if your network of cashless hospitals and the hospital and the doctor that you work with are all in sync with each other, saying that, okay, this doctor is associated with this hospital is a part of the network for this insurance company, then it makes your life much easier because everything is in sync with each other. If not, then obviously there are ways out of it where you go out and do a reimbursement claim because you say that, getting to the hospital was more important than it being a network hospital. I will figure out how to make the payment initially and then get a reimbursement by giving the bills, etc. But I think it's important to think through how this would happen. And I think for a lot of people, they also need to keep in mind that they may have an independent health insurance cover, which may have a certain set of network hospitals. And then they could have a company cover or a corporate cover provided by their employer, which could have a different set of hospitals on it. And therefore, which of those insurance covers are you likely to use would also dictate how this process will work. And all of this is not possible to do instantly when an event happens because you're trying to focus on the patient. And that's why some of this planning in advance, maybe even speaking to family members saying, this is what we are thinking about. Let's say if something happened to me, this is what I'd like you to do. If something happens to you, this is what I'm thinking should be the approach to be taken. Are you okay with it? And I think that way the decisions can be very quick.
Yeah. And time is of the essence, of course. That goes without saying. I will circle back to what to do if you don't have available cashless facility. But to that end, what should people who currently have a Bajaj Allianz policy do? Should they look to port? It's not the easiest thing to do, is it, Vishal?
Yes, I think it's not easy to do it. And what we need to keep in mind is that, by porting, you may not be able to permanently solve this problem because the list of network hospitals, for example, can change over a period of time. So there are hospitals which can go out of a network. There can be other hospitals that come into a network. Similarly, you could end up in a situation where there could be times where a particular insurance company, like Bajaj is facing right now, is not being given cashless. But that doesn't mean that a similar sort of thing could not happen to other companies as well. And therefore, what we need to keep in mind is that this is a moving item. And therefore, for you to be able to continuously port may be hard because today, if you port from Bajaj and go to someone else, you might find that you run into the same problem with another insurance company at some point in the future. So you need to keep in mind that you'll have to do two things parallelly. One is build your own independent emergency fund solution to take care of events of this kind which can happen. Because you also need to remember that porting can only happen 45 days before your insurance premium is due. And therefore, let's say if you've just paid your insurance premium to Bajaj and your next premium is due only 1 year later, then what do you do for the next 9-10 months is the question that needs to get answered. So I think porting may not be as simple a solution as possible, and therefore you might have to look at the other alternatives to see how this can sort of come through. And that's where even your company cover could be valuable, because a lot of times when we speak to families, they do not have enough information itself about their company covers. They don't know who's the provider, which is the network hospital, who all are covered, to what extent they're covered, how does it work in case there is an emergency. So I think a lot of this itself is missing, because somehow it always appears that emergencies will happen to someone else but will not happen to me.
Yeah, I mean, you said it. I couldn't have said it better. So therefore, the point that you've just made, in the case of those people that have these policies, you might have to look outside of the network, right? For those that might just give you cashless. And beyond that also, you might want to build up on an emergency fund or bolster it till this resolution is found. But let's talk about how that is constructed, because Vishal, it's not the easiest thing for a lot of people to do. And I've often asked this question, and frankly, I don't think that I've gotten the best solution here, right? Because if I go to somebody who's 25 or 26 years old and I tell them, look, you're going to have to save 6 months worth of your expenses, they have universally looked at me funny. And they've said, what do you mean? I can't take care of this week's expenses. How do you expect me to set up that kind of a fund? Is there an answer here?
I think it's a real challenge, because what ends up happening is, obviously when you're younger, your probability of having that emergency for yourself reduces. It doesn't mean it can't happen, but it just is a lower probability. And I think that's where it's important for family structures to be thought about in the right manner. So you could find that there could be families where there are dependents. There could be, parents, for example, who need to be taken care of. In those cases, the question really is that, who's expected to create that emergency corpus? Is it the 25, 26-year-old, because he's the only one who has, who's the earning member, and the dependents or the parents are older are not earning? Or have they created their own emergency corpus for these kind of situations already? I think what we find very often is that families are not talking about this enough, either because it's a slightly sensitive area where you talk about things which are unpleasant, like a medical emergency, or it happens simply because everyone's assuming the other person's doing their job and their role. And therefore, there is no consolidated view being taken on this. And therefore, you could end up in a different situation as well, where two sets of people are taking two emergency funds and building it up parallelly. And therefore, as a family, you have too much emergency provisions getting created as compared to what you required. So I think, the thought that you need to take a very nuanced and a careful decision on this cannot be underestimated. I think the way to think about it is, once you've understood dependencies, how much corpuses have already got created, you now start to look at pre-existing conditions. Obviously, there are pre-existing conditions that exist. Let's say there's a diabetic in the family, someone has high blood pressure, someone's had a cardiac history, etc. Then the need for this buffer may need to be larger, simply because the probability of something like an emergency happening could be higher. No one knows whether it will or not, but the probability increases. And therefore, the way we think about it is anywhere between 3 months going all the way up to a year, maybe the tiered approach that families take. And one of the things that we found work well for younger people is that, if you tell them that first create the first 3 months of emergency, I think they don't have the patience for that. But if you tell them that out of every, sort of rupee that you save, can you put a part of it aside towards your emergency fund? And therefore you keep bolstering this over a period of time. And hopefully, the emergency doesn't come up so quickly. I think the acceptance is much higher when you tear this out rather than try to do it all in one shot.
So to that end, how do you go about it, and where would you put this? Would you put it in different buckets, even within that emergency fund, and use, I know a lot of people use liquid funds. Some people are gravitating now because of tax purposes towards arbitrage funds. I don't know if that's the best idea, because you would want to keep it very liquid, and arbitrage is T plus 1, right? Is it not, or is it T plus 2?
T plus 2.
Yeah, T plus 2, right? So therefore you need to have availability of funds very quickly in the event of an emergency. And also, should you put your credit card into that? Because ultimately a lot of people say that you should go and swipe your credit card in the event of an emergency.
Yeah. So I think there are many different ways that people can use it. And obviously, a lot of this depends on preferred approaches. So for people who have credit cards which have decent limits on them as well, I think a credit card initial swipe is a good idea, because what it does is it gives you access to the money immediately and allows you to focus on the core issue, which is getting the treatment started for the patient quickly. The challenge with credit cards is, of course, if your limits are already used up, or you tend to use this as a more permanent solution rather than just an immediate liquidity solution, saying that, in the next few days, while the treatment is going on, I will find the other sources so that I can pay off my credit card as quickly as possible. I think that's important to be clear about, saying use the credit card first, but use it very prudently and allow it not to roll over, because the cost of the credit can then otherwise be extremely expensive. Now, while this is happening, there are different approaches that people can do for their emergency fund provision. So either it could be a liquid fund, or it could be a savings account which has a linked fixed deposit to it. So there are these accounts which have a sweep in, sweep out facility where the money goes to a fixed deposit and then comes back out of it if needed. There could also be the use of arbitrage funds, like you mentioned, or there could even be investors who are using short-term debt funds, saying that the volatility on the instrument is going to be very low, and I don't know when this emergency is going to happen. So, rather than being in a liquid fund instrument where my rate of return will typically be lower, I'm okay to park a part of it into a short-term debt fund as well. What some people also do is they create credit lines. For example, against a fixed deposit, you can create an overdraft credit line, which will only come into play in case of an emergency. So there are different approaches that people can take, and there is no one size fits all on this, because it depends on the tax bracket of the individual. It depends on their own discipline of using that credit line only for emergency purposes and not using it for shopping, for example, saying that for me right now, shopping at Ganpati is an emergency because I need this new wardrobe, or I need to travel, or some of that. So I think there needs to be a very customized approach taken to the emergency fund without not creating the emergency fund because you're confused. I think our suggestion to people is that if you're confused, give up 1% or 2% of returns and just park the money aside, so that in the case of emergency, you have money available.
I love that you said that with such a straight face. The unavailability of clothes in your wardrobe during a festival is an emergency. It certainly is for a few people, but I guess from the perspective of managing your money, the emergency we're talking about is very different. Vishal, final point, and this is going to put all of what we've spoken about into context. Ultimately, people have limited resources, and so they have to put things in an order of priority. And we've discussed health insurance, we've discussed an emergency fund. How do you layer that in the order of priority? Of course, a lot of people say that you need to have health insurance even before you think about investing.
Yeah, so we certainly agree with that thought, that there is a need for health insurance to be there. And I think the important part about health insurance is also to define how much health insurance do you need. I think one of the things that we see happen very often is that sometimes there are tick-offs that happen, just saying, do you have an emergency, do you have a healthcare fund, a health insurance policy? Answer is yes. The question is it adequate? If you're in a large city and you have a an emergency which is large in terms of healthcare requirements, is a 50,000 rupees or a 1 lakh rupee cover going to be enough? So I think you need to get to getting the right amount of health insurance as well. Do not depend completely on your company health insurance cover because of the fact that you may not always be employed, and there can be times where you're between career shifts and therefore exposed if something happened to you. It's also important to keep in mind that health insurance is not just for you, but for everyone else that you may need to support financially if an event happens. So it could be spouse, children, parents, in-laws, siblings if they're dependent. So you need to look at all of that comprehensively. Once you've got the health insurance piece right, that's your way to knowing that hopefully my finances will not get into a mess because of a health emergency. Now I have to address the liquidity issue, which through a cashless process I could have addressed because I could get the cashless to take care of it. But if I don't have cashless, then I need to ensure that I can get liquidity available, or there might be certain things that my health insurance company does not cover at all. Certain illnesses for a certain period of time, or within the expenses as well, there may be certain consumables which are not covered, etc. So that's when it becomes important to start thinking about your emergency fund as well. And we need to keep in mind that emergency funds have multiple uses. They're not just for healthcare. They could be because you lost a job. They could be because there is suddenly someone who's very close to you who requires some money. And you need to step in to support it, or would ideally want to support it if you could. So that emergency fund is not just a healthcare provision. It can be used for multiple purposes. And then you get to investments. Like I said, for a lot of people, doing this one after the other can be very stressful. So for those sets of people, sometimes you may choose to do this concurrently, though it's not ideal.
Got it. I think it's been a fantastic conversation. Thanks so much for joining in, Vishal, and for speaking to me on this show.
Taped out at a semiconductor laboratory in Mohali. Imagine college के students, universities के students chip design करना और उस chip को manufacture कर पाना. दुनिया में बहुत कम universities हैं जो इस तरह का claim कर सकती है, और दुनिया में बहुत कम देश है जहां पर इतनी बड़ी संख्या में स्टूडेंट्स को लेटेस्ट मॉडर्न सेमीकंडक्टर चिप डिजाइन टूल्स अवेलेबल है. वो उसको यूज कर रहे हैं, यूज करके चिप्स डिजाइन कर रहे हैं, और चिप्स डिजाइन करके उनको मैन्युफैक्चर भी देश में कर पा रहे हैं. बहुत बड़ी ताकत बनने वाली है भारत के नौजवानों की. बहुत बड़ी ये स्ट्रेंथ बनने वाली है भारत की पूरे टेक्निकल इकोसिस्टम में. और ये विजन है प्रधानमंत्री जी का, जिस विजन के कारण आज भारत एक उभरता हुआ सेमीकंडक्टर हब बन रहा है. और इसमें गुजरात का बहुत बड़ा रोल है, क्योंकि गुजरात ने सबसे पहले सेमीकंडक्टर पॉलिसी बनाई, और उस पॉलिसी के साथ साथ उसका बहुत रैपिड एग्जीक्यूशन भी किया. मैं आप सबको बधाई देना चाहता हूं, और इस बहुत शुभ अवसर पर कंप्लीट सीजी टीम को, आईएसएम टीम को और गुजरात टीम को बहुत बहुत अभिनंदन. धन्यवाद.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or all of these other things?
As a child, I enjoyed playing tennis, so I always thought that okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Well, the US has imposed 50% tariff on India, and with this tariff kicking in, the textile sector is expected to be one of the most impacted because of this. Now, to discuss the same, we are today joined by Pallab Banerjee, the MD of Pearl Global. So, sir, in FY25, if you look at the exports to US from India of textiles stood at close to $25 billion US, and with this 50% tariff kicking in, what has been the early impact of the same on the industry? Have exports from India halted to the US?
So, it has not halted as of yet. But what's happening is the current production, which was already happening, because if we talk of garments, especially the apparels, it's a fashion product. So it's done season-wise. And this is the time when India, normally, or across the world, US actually places the spring and summer products at this point of time. which are supposed to be delivered in the month of November, December onwards. And it reaches the store. That means it's on sale in the month of February, March onwards. So this tariff, the timing of the tariff has come in such a point of time that this new order booking is definitely under pressure. The retailers and the brands of US who buys from US, almost $6 billion of apparel is going out of India. So they cannot absorb this extra 25% of tariff. In fact, if you look at it from the competing countries like Bangladesh, Indonesia, Vietnam, and all the other countries who manufacture apparels, India is at 50. So that makes a gap of almost 30%. And the penalty that we're talking about out here on top of our existing 25 is another 25. So both ways, if you look at it, India is not competitive by approximately 25 to 30% additional tariff. Now, if this is the impact which the retailers and the brands cannot absorb, so they are putting two conditions on the apparel manufacturers of India. Either to absorb this tariff, that means like we reduce our selling price by almost about 16% to avoid this 25% tariff. If you do the maths, like whatever we are shipping out at a lower price by 16%, after tariff would be same if this 25% tariff was not there. So they want that kind of price reduction, or they are pushing us, like for example, Pearl Global, the company that I'm representing, is we have manufacturing across the globe. We have in Bangladesh, Vietnam, Indonesia, and Guatemala, as well as India. So for a company like us, they're pushing us to shift the US manufacturing to other countries. Or if we're doing it out of India, then we somehow absorb this tariff burden. So that's where we are sitting. And yes, the people like who are not able to do either of these, they are going to lose the business. So this is what the situation is at this point of time.
Right, sir. So are you suggesting for the sector as such, as a whole, that 25% of the tariff is something that US clients are ready to bear, but the additional 25 they are asking the Indian exporters to bear at this moment?
Yes, that's correct. Well, first 25%, because if you see, all other countries are in the range of 19 and 20%. So the difference is less, 5%, although like India will have a uncompetitive by about this 5%, which even it can work out if India specific product, which is easily available in India, but is difficult to make in other countries. So that 5% can be shared between the two businesses, the clients and the manufacturer or the supplier from India. But when you talk of a 20 or 30% difference, then it is not possible. So this is what the situation, how it is being played.
Right, sir. As you were mentioning that the other Asian countries have a lower tariff, but what about China? Do we still have an edge over China? And what is the loss of share that you're expecting can happen if this penalty of 25% continues for a long time?
So you see, like, Indian industry was expecting that most of these, or not even Indian industry, but also the US industry, was expecting that China as a country, like, who will have to bear more penalty. And they were getting ready to shift a lot of business into India, because the whole China plus one that we have been talking about or hearing from US and other countries. So now what has happened is suddenly after this final tariff of, which is kicking in on 27th of this month, that's yesterday, India product attracts a 50% tariff, additional tariff over the MFN, which you used to pay, every country used to pay. And China has to pay about 30. So India is in a disadvantage from China today, even with this latest tariff, because China got an extension for this 90 days, which India didn't get. So in that situation, India is now at the highest level along with Brazil for tariff into US.
Right, sir. And right, you can continue, sir.
Oh, you had a second part of the question. Sorry, I missed that. Can you repeat the question?
The second part was on how much loss or market share loss are you expecting for Indian exporters compared to other Asian exporters and China if this tariff continues?
So China has been very, very competitive, despite the tariff which was placed on China by the earlier Trump administration when he was there in 2016 to 2020. And now again at 30% and less than even let's say consider that India is 25 and China is at 30%. In that situation, China will be able to absorb because that country, there are a lot of these benefits that the government is giving to the exporters, specifically to generate more of, because their economy is all export-led economy. So because of which they have been very, very competitive in the US market. So what we expect is that at this point of time, if India remains at 50% for, let's say, even for 3 to 6 months, I fear that India will lose a major share of this business. The 6 billion may come down to hardly about 10 or 15% will remain in India. Because why am I saying this? Businesses, big businesses like ours and others, some of others, we may absorb this for one season, but cannot be prolonged to absorb because none of the businesses are having this kind of margin to continue like this. So that's the biggest fear at this point of time. So we are looking forward to some kind of solution. In fact, I heard Scott Bessent, the Treasury Secretary, yesterday said that the discussions are on between India and the US, and we should have a solution soon, I guess.
Right. Yes, there have been multiple discussions, and as you were mentioning that, yes, margins are at a single digit for most of the players in this industry, so it will be quite difficult for them to bear the brunt. But I just wanted to understand here, has the industry, or is there any talks between the industry and the government, any kind of subsidy that is expected to come in to protect the industry at this moment, given the fact that textile is one of the most labor intensive sector at this moment, and if India continues to lose the business, it would be quite negative for the jobs industry as well.
Yes, because textile industry or the garment industry definitely employs a lot of first generation of workforce if it comes from farm or from home to work. And, operator working in a garment factory can be trained in a period of maybe 30 to 45 days, reasonably well, so that he can start, she can start work on it. And also it employs the maximum number of women. So definitely it's important to India to have this sector. The government is definitely engaged with the various export promotion councils at this point of time to see what are the benefits that can be brought about. So we do expect and hope. But the most important part is that whatever has to be done now, immediately. If it is done after 3 months, we will lose a huge share of market. And to bring that business back into India will take many years. So that's the important part because, like this particular sector works season after season. So we are at this point of time, spring, summer is the peak season for the Indian manufacturers. And if we lose this at this point of time, and if these US customers find a home in other countries for this same product, then to bring it back into India would be more difficult.
Right, sir. So as you were mentioning that you have plans in various other countries, so you would look to shift your production from India to other countries, how much ever exports you are doing to US. Just wanted any ballpark number if you have for the $25 billion of exports that currently India is doing to US, how much of this could be shifted to other countries?
This 25 includes many categories of product. So if you look at only apparel or the garments, that's approximately about 6 billion. Then we have textiles, then we have let's say the home furnishings. So it's a whole gamut of product which is talking about this 25. So I can give you a specific reply for the $6 billion, and also like as you said, like what is my company is doing. So what we are doing is that we do not want to lose any market share from our customers. So naturally, like the same product, if it is shipped out of India or manufactured in India, it attracts this additional penalty tariff. And that's if the customers are not willing to pay, then I have to make those production in other countries like Bangladesh, Indonesia, Vietnam, or Guatemala. So that way, like I will retain the customer. And then when this tariff is removed, then I can bring that product back into India. That gives me one more challenge, which is what is to happen now. The factories and the employees that we have now working, so what will happen immediately? So that's a big concern. We do have almost about 50% exposure of our total turnover into US market, and India is about 25% of our total top line. So that means if you see like almost 12.5% of our total top line is at this point of time at risk, which is placed in India. So this business have to be replenished by some other goods, other customers for markets like Australia or Japan or European Union and UK. So these are the places that we would be looking into. UK and European Union had a FTA, which are basically a free, almost duty-free agreement with some other countries or competing countries as well. So India was not so strong in these countries, whereas Japan and Australia, we enjoy an FTA. So that means we are as competitive as any other country. So that's something like as an industry, have to look into. So yes, Pearl Global is definitely more ready, I would say, compared to some other players who might have a very high exposure into US. So that's the big concern that India and the government and the industry bodies or the councils have to immediately address. So that's the situation on ground as of now.
Right, sir. Just one last question here. Assuming the 50% tariff continues for India for some more months going forward, then are you confident, or do you think that Indian exporters will be able to make up for the business loss from US by exporting to other countries, the countries that you were mentioning? We have FTA or other emerging markets as well.
So the problem with emerging markets is that it doesn't have the scale and it doesn't have the price points. So US is attractive. That's why, US and European Union, these are the two big markets, which has got the size and the depth. European Union, definitely it's many countries, but US is one single country, and the brands and the retailers are quite substantial and very well organized out there. So that definitely is more attractive for the Indian manufacturers and other countries' manufacturers to supply to US. Now, if you take out US from this whole equation, then it's definitely challenging because the margins and the scale and the volume that is there may not be existing in other. I think comparison you can talk about is European Union, followed by UK, and followed by, let's say, Japan. Then comes Australia and all other countries, like whether it is the big countries or if you go to the South America or African countries. So those are like still not in comparison to the attractiveness of these markets. So that's the reason, it's a challenge at this point of time. And anyway, like if you want to build it up, it takes time. For example, Japan always look for zero defect kind of product. So the infrastructure that is needed has to be higher. So we as a company have been working on it for the last 5-6 years. So now we have a reasonable equation with Japan. But again, to scale it up from where we are today to make the full capacity of India into these markets will take a little time. More about, I would say, a timeline of at least about a year. So the challenge is immediate. What happens to the next 6-8 months? This is for Pearl. And if I talk of, in general, the rest of the industry, if this readiness is not there, most probably the immediate solution would be to shut down or to scale down. So that's the biggest worry.
Right, sir. Well, thank you, sir. Thank you for joining us and explaining the impact of this 50% tariff on the industry and Pearl Global currently.
Let's get him in, Mr. Jalan, Managing Director, Ramkrishna Forgings. More importantly, viewers, a veteran in this space who has looked at multiple such cycles. Mr. Jalan, I dare say, is this cycle or is this piece of this additional 25% punitive tariffs and the uncertainty around it very different from any of the past cycles that you would have seen?
Yes, I think obviously this tariff is one thing which we had never imagined also when we started our exports. And I think this is punitive measure, I think, but all said and done, it's, I think, part of business cycle and it's going to go away. I think we are very hopeful that in coming months or days, maybe that, because US does not have a capacity to manufacture forgings as a low-cost country. And I think it will sooner or later realize and this punitive measures are going to go away.
Mr. Jalan, when we were talking to some of the textile companies or one gems and jewelry company unlisted, but in this space, they were talking about some uncertainty as things stand around order bookings post the next 3 months. What is your experience, sir, in terms of your conversations with your key clients in the US? What are the conversations looking like?
No, I think we don't see any uncertainty in terms of new order book or new order wins or new RFQ getting floated. Right now, the demand per se is on the lower side. And I think because of this uncertainty, the overall demand in the US economy is down in terms of passenger vehicles or trucks. The overall demand being down, that's the reason we are seeing less offtake. Otherwise, in terms of pulling out business or shifting business, we don't hear or see any incremental news coming out of US for us. Or I think I can say for entire automotive segment, I don't think there is an alternative to India in terms of the auto component sector.
That's interesting. No alternative to India as well. Mr. Jalan, good morning. Hiral on this side. So let's understand. When you talk about RK Forging as well, the company has substantial exposure with regards to the North American market, right? And this particularly comes in from the commercial vehicle components which are used in Class 8 truck orders. Now, the question is your Class 8 truck orders is already under pressure over the last couple of months right now. It has been dwindling. So you're already seeing that kind of an impact that does come into companies like yours. Now, secondly, when you talk about the tariffs as well, the other aspect everyone is talking about is alternative routes in terms of other countries, which you can look at. Or secondly, looking at diversification in different sectors. What is the strategy that Ramkrishna Forgings is going to look at?
No, we are not looking at any diversification in terms of our manufacturing facility is concerned. We are doing well with our customers, and I think we have been able to, in past couple of months post the announcement of tariff, been able to negotiate with most of our customers in terms of pass-through of the tariff quantum. And I think we are well on track in terms of our new order wins and new sectors within North America. So I don't see that as a challenge. Right now, the biggest challenge which we are facing it is on the demand side. I think with all this tariff and uncertainty, the demand within US for all kinds of vehicle, whether it is, it's not limited to trucks or Class 8. It is sectors as a passenger vehicle or light commercial vehicle, every sector is showing a downward trend. That is what is challenging for us. In terms of tariff, I think it is a cost impact, but it is a cost impact for the customer. And we are trying as best as possible to become more competitive in terms of doing more value engineering and doing all sort of engineering to reduce the cost of the product. But in terms of tariff, it is a pass-through for us.
Okay, so tariffs will be a pass-through. The other question I have is...
Sorry, if I can just ask in one question. Mr. Jalan, appreciate it's a pass-through, but will there be takers for a higher-priced auto component product from India? I heard you say that there are no alternatives to India, but will there be takers if indeed the pricing is so high?
So I think that's my answer earlier also. They don't have an option.
Alternative, okay.
I think within US, I think you don't have a manufacturer, and in terms of auto tariff, it is uniform for all the nations across the globe. So 25% tariff is what everybody pays. The additional 25% tariff which has been announced is not applicable for auto components. So obviously we are limited to this 25%.
No, so Mr. Jalan, So Mr. Jalan, one clarification over there, on the back of what Neeraj asked you, is there any supplier that could supply from Mexico as well? Because that has been taken as an alternative when you talk about auto components. And number two, when you talk about auto components as well, the tariffs do range from 25% to 50%, right? There are some components that do fall under the 25% bracket. There are some components that do fall under the 50% bracket. So anything that any clarity that you have on that front as to which are the components that fall under the 25% bracket, which are universal across the globe and which do come into the 50% bracket?
So in terms of my company, I can say all my auto component exports fall under 25% category, and there is no export which falls under 50% category for auto components. Only forgings which fall under 50% category are non-auto forgings, which is particularly goes to oil and gas. So that is one sector wherein 50% tariff is applicable. And that is not today. That is the day steel and aluminium tariff were announced as 50%. That tariff has been applicable. This 25% punitive tariff, which has been announced later on, is not applicable to any of them. So from day one, we knew the 50% and 25% auto tariff, 50% is for steel and aluminium, and 25% is for automotive.
So Mr. Jalan, would it be right to say that because 25% is a universal tariff across the globe, with regards to where auto components go, I'm talking about forgings, everyone's competitiveness continues to remain the same as it was, because they will see a similar kind of price increase, that cost competitiveness, so not major things that change around then?
Yes, I think that's right. I think that is what we have been always telling, that it is going to be day as usual for everybody. Everybody has to ultimately go and pay this tariff, except for Mexico and Canada. But both these places also buy forgings. Today, out of my North American export, 80% of my forgings go to Mexico. So basically, the forgings which go into Mexico are converted into finished goods, and then they will enter to US. So obviously, Mexico also does not have any large forging facility. So I don't think any pullback of order is going to, or we are going to see any cancellations of order. Whether it is limited to our company or whether it is limited to India, we don't foresee any major setback in terms of orders and inflows of new orders.
Got it. Okay. Mr. Jalan, just trying to bifurcate this for the portion of the tariffs. Sorry if I'm repeating this, and sorry if I have to repeat it, but just wanted that clarity. For the portion of the products which might be subject to 50%, would there be takers at that higher price, or you reckon the supply chains might get shifted?
So, like I said, whatever tariff is applicable at 50% is majorly for oil and gas and non-auto components,
right,
which fall under steel and aluminium. So that 50% steel and aluminium, 50% is applicable throughout the globe. Nobody has been given nobody has been given an exemption for this 50% for steel and aluminium.
Got it.
Whether it is China or anybody. So I think everybody will need to ultimately pay, other than creating a new manufacturing within US.
Got it. Okay, just one more question, Mr. Jalan, from my end at least, and which is just the natural course of diversification that any business would want to do, and maybe that gets heightened, not because there is a tariff that is looming, but because of the nature of the conversation that has happened with other sectors, that you might want to diversify away from a point of concentration into other areas. Are you contemplating that as well, Mr. Jalan? You're not hit by tariffs, but you may still want to do it as prudence.
I think as prudent, we took this effort, I think 2 years back itself, when we started looking at more and more businesses from Europe and other places, Southeast Asia and other places. And I think we are working very diligently and very focused way in creating a parallel North American business platform within the Europe. And I think we are not far away. I think we should be in next 8 to 12 quarters reaching there, wherein our European operations or European businesses is going to be equal to or bigger to North American business.
Right. Mr. Jalan, and when you're talking about, the demand as well, I was just looking at the Class 8 truck orders, and it's actually reached a 16-year monthly low, while medium duty orders are the weakest since the outset of the pandemic. Now, even FTR, they've indicated that these numbers are coming in, and it's seeing this kind of a downtick mainly on the back of tariffs. And secondly, the freight rates, everything is becoming a concern. Now, if this is the scenario that will continue, what is the kind of impact you will see overall in terms of FY26 and FY27, because Class 8 trucks also is one of the biggest aspects that you actually supply to?
No, I think if you see the August numbers which have come in the month of September, I think this has shown an uptick versus July, and that brings an optimism. I think with all these tariff issues right now behind us, I think people will now start living with tariff. I think the way forward, people will need to understand the way of life is tariff is not going to ever end. So I think it's going to be, at some point of time, there is going to be an inflection that we are going to get back to normal. We are not seeing peak, but we are going to get to normal of 16,000 vehicles a month. And I think maybe in next 3 months, maybe in 6 months, that's going to be there. But in terms of RKFL, I think with the new business wins within North America, already starting to create revenue, and also within Europe, we are seeing in next 6 months to create revenue. I think we should be. I think we are looking at in next couple of months worst days to be behind us, and I think we are going to be back on our track of growth.
It's going to be interesting. 16,000 in the next 2 to 3 months. If you talk about Class 8 truck orders, that is an absolute rebound that the street would see as well. But thank you, Mr. Jalan, for being patient and speaking to us. Yes.
That is an optimism an entrepreneur has to stay with.
Absolutely. Optimism is what is the need of the hour right now.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold
CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
Any point in your mind a thought of something, as you mentioned, cooking or, all of these other things?
No, as a child, I enjoyed playing tennis. So I always thought that, okay, I'd love to be a tennis player and play at Wimbledon, but I didn't even reach state levels.
Biggest advantage and one biggest disadvantage of being in the position that you are as the next generation of a legacy business?
I think the biggest advantage is long-term thinking. A negative, sometimes the perception of family businesses from the outside can be one where it lacks professionalism.
The next generation in a family business is the most important generation for the future of that business.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
scholars from India and across the world. Connect live, ask, decide, and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research.
Good evening, you're watching The Big Question. I'm Sanjana. What started as a hopeful promise to dramatically boost US-India trade quickly spiraled into one of the toughest tariff challenges that India has faced in recent memory. Now this evening, what we're going to do is unpack the unfolding story behind the tariffs, how geopolitics turned the tables, with Russia punished, China contained, and India pressured as a rising power in the Indo-Pacific. We'll explore the immediate impact on India's industries, the cushioning effect of domestic reforms like GST, and broaden the lens to contrast India's treatment with US policies towards other global players like Russia and China. Because viewers, as India stands as this very critical crossroads, this conversation needs to dig deep into whether these tariffs represent a crisis to be feared or a catalyst for urgent economic recalibration and strategic resilience. Let's get right into it. What began in early 2025 as an ambitious promise to turbocharge the US-India trade has quickly turned into a defining economic standoff. Prime Minister Narendra Modi's pledge to double bilateral trade to $500 billion by 2030